As Celeste mentioned, my name is Paruk. I head up the equity capital markets team at RMB. We're based in Johannesburg, but our footprint extends throughout sub-Saharan Africa, and we are active in a number of African equity markets, including Nigeria, Kenya, and Botswana. My presentation today will cover two main topics. The first is a quick overview of equity market activity in Africa, highlighting some of the key trends that we're seeing in markets. And the second is to outline some of the key considerations we see coming up time and time again when talking to clients about raising equity capital or potentially listing and raising equity capital. Moving to my first slide, this just tries to map out some of the flows that we've seen in equity capital markets over the last 4 or 5 years. As at 31 December 2015, African exchanges had a market capitalization of over $1 trillion. The biggest and most sophisticated market in Africa is South Africa, with a market cap of over $100 billion US. Other key markets in Africa include Nigeria, Africa's largest economy, Egypt, and Kenya. Combined, these 4 markets contribute over 85% of equity capital markets activity or deal value since 2011. And although Africa is currently facing several headwinds from a macro perspective, as Celeste has highlighted, we still believe that there are a number of fast-growing African economies and that this growth will continue to underpin equity value growth and deal volumes over the coming years. 2015 was a record year for equity capital markets activity in general, with over $12 billion being raised in roughly 119 deals. This is up 13.4% from the prior year by deal value and up 17% in the number of deals. Despite the equity market volatility in 2014 and 2015, IPO volumes have also rebounded from a low in 2012 of $400 million to a record high of $2 billion in 2015. And this is a 4-fold increase in just over 3 years. Turning to my next slide, we've done a bit of a deep dive into some of the key markets in Africa. South Africa remains the core IPO market in Africa and contributes 45% of overall equity capital market volume since 2011. In 2014 and 2015, we saw a number of landmark transactions, including the IPOs of Rhodes Foods Group, Alexander Forbes, and Choppies on the JSE. The Choppies listing in particular in 2015 was a very successful secondary listing of a high-profile Botswanan business on the JSE. The deal resulted in the company raising 1.4 billion rand split between primary and secondary shares, with the primary capital being used to fund business growth. The stock has performed very well since listing, and liquidity in both the Botswana line and the JSE line has been excellent. The IPO markets are highly correlated with overall market volatility. As volatility increases, IPOs become more difficult to execute. We saw this in 2015 in South Africa, where 2 large deals were postponed at the back end of or in the second half of 2015 due to market volatility. However, the pipeline remains relatively strong in South Africa, and we see and we hope to close 4 more deals in the next 18 months, raising in excess of 4 billion rand. More importantly, we continue to see appetite from investors for deals with attractive sub-Saharan African exposure, and it's the key investment highlight for investors looking at and evaluating companies coming to market. The impact of volatility is also prevalent or illustrated in looking at the charts for Egypt, Nigeria, and Kenya. In Egypt in particular, last year was a surprise year where they raised $752 million of equity. This was largely as a result of the increased political and economic stability and the return of capital to those markets. And as Celeste mentioned, Egypt is a key market in Africa with a very strong growth profile over the next couple of years. Focusing a bit more closely on Botswana and the Botswanan equity markets. Although Botswana is a relatively small economy or market in the context of some of the other larger African markets, the Botswanan public markets have been supportive for Botswana-listed companies over the last 4 years. Since 2010, there's been 6 IPOs, with the 2 landmark transactions being the dual listing of Wilderness in 2010 on the Botswana Stock Exchange and the JSE, and the Choppies IPO on the BSE. RMB was involved in the Wilderness IPO and also the Choppies follow-on deal, and we found in both instances that there was strong support from the local capital base, as well as good interest from international African-focused investors for equity in those deals. And that highlights the comment that was made earlier by the BSE. I think the BSE has taken a number of steps over the last couple of years to improve the quality of the platform and increase the attractiveness of the exchange to international investors, and I think that will yield benefits in the coming years. Moving on to my second topic, some of the key considerations that companies should think about when thinking about a listing or an IPO. We're often asked the question as to why companies would look to list. And again, I'm going to quickly go through this slide because it was covered by the BSE earlier. The first tends to be to access capital for growth and/or balance sheet restructuring. We found that growth-focused use of proceeds generally receives a better reception from the market. The second is to provide liquidity to existing shareholders. I think the market understands this use of this rationale for listing, but at the same time, the new investors don't want to see existing investors exiting entirely on IPO. The third is to raise the profile of the company, and this has several benefits, including enhancing the brand equity. The fourth is to create an acquisition currency, which the company can then use in M&A, and it also creates a market benchmark for valuation for that business. And the fifth is then to incentivize and retain talent. The decision to IPO is typically made for a combination of these reasons, and in our experience has been focused primarily on number one and number two. There are some drawbacks to being listed, and the biggest of which is probably the amount of management time and effort that it takes to, one, get listed, and two, continue to engage with investors subsequent to the listing. I think an investor engagement process and protocol is critically important for listed businesses to maintain liquidity and interest in their stock. And I think at the end of the day, the business needs to create the capacity within the corporate structure in order to allow management to still engage with investors, but at the same time have enough time and energy to focus on the business. The second question we tend to be asked quite regularly is, so once we've made a decision to list, where should we list? And I think we like to think about this as a couple of questions. So where is the natural home for the stock? Where are the operations based? Where is the management based? And what is the brand awareness like in the market? The second is the market and the platform that's provided in that market efficient and liquid? Does it provide the best platform for investors to trade that stock? The third is whether there's a financial following, whether there's market interest in IPOs and trading shares, and whether there's research analysts following the stock. I think all of those are very important to maintain interest and liquidity in the stock going forward. And then the last is really whether it provides you with access to the right investors and whether that investor base is domestic and international. Sorry. What defines a successful IPO? In our view, this would be a deal that is oversubscribed, that is done at an attractive valuation, that results in a high-quality shareholder base for the company, that results in good aftermarket liquidity and stability in the share price, and ensures full regulatory compliance. How do you achieve these objectives? In our view, it's by making sure that the company is appropriately prepared to come to market, that the process is structured in the right way, and that in the marketing process, that the right investors are approached and targeted to invest in the stock. A good IPO advisor can assist you in every aspect of this process. What does this mean? This means that the IPO advisor will assist you to prepare the company, to make sure that the right legal and corporate structure is in place, to make sure that the right financial reporting procedures are in place, and that the right executive remuneration structures are in place. In addition to that, they'll make sure that the right capital structure is put in place for the business to allow it to continue to fund growth and pay a dividend, and so that investors don't see the company as overgeared or undergeared when it comes to market. They'll also make sure that the investment case and the positioning of the business is appropriate and positioned so that you achieve a maximum valuation on listing, and that positioning is captured appropriately in the documentation. We'll also make sure that the deal is structured right and that it's marketed to the right set of investors. And then ultimately we'll give you the right advice around when to come to market, because ultimately the timing of your approach to market is critical in determining whether there's going to be a successful IPO or not. Good IPOs are done in supportive markets. Just to close, to spend a minute on sort of who we are as RMB Morgan Stanley. RMB Morgan Stanley is a joint venture between RMB, a leading investment bank in Africa, and Morgan Stanley, a leading investment bank internationally. We have a very good track record of helping African and sub-Saharan African businesses come to market. And I think we believe that there continues to be a lot of appetite for investors to invest in these opportunities, assuming that it's appropriately structured and brought to market in the right way and at the right time. Thank you.